everyone, and welcome. My name is Peter Kerr. I'm a senior director here at Yieldtree. Today, I'm joined by Fahd Bazir, who leads a lot of our private credit opportunities. Today, we're really excited to talk to you about one of our more recent opportunities in the private credit space, Powersports Loan Portfolio. Fahd, welcome.
Thanks, Peter. Great to be here. Look forward to chatting more.
So, Fahd, a lot's been made about private credit, and certainly there are a lot of opportunities. Perhaps you can take a second to walk us through a little bit about what private credit is and also the market backdrop that's really supporting private credit right now.
It's a big market in the news all over the place today, articles in the journal and the websites. I would think about private credit in four major food groups: direct lending, which is probably what you hear about the most, asset-backed finance, trade finance, and opportunistic. Breaking that down a little bit further, you're investing into contractual streams of income. That's the basic premise behind it all. These are investments in things like large companies that don't issue bonds in the public markets. These are things like investing in asset-backed pools. These are things like financing international trade, import-export. It's a really interesting market today for a variety of reasons. Number one, base rates, as we all know, have increased pretty dramatically. So at a baseline, you're going to earn a very high rate of return, even though you have this sort of contractual stream of cash flow. It's not equity, it's debt. Two is the fact that you have major bank regulations, which are tightening up, making it more difficult for traditional lenders to lend. That creates huge opportunities for people like us. And it's just a massive tailwind that we think in the next 12, 18, 24 months, creates a huge source of really, really interesting risk-adjusted return.
So more specifically about the investment that we're talking about today, what is it really the opportunity that you saw?
Firstly, this is within those food groups that I described. This is within asset-backed facilities. We are investing into a pool of receivables. That's the basic fundamental premise behind all of this. The ultimate exposure is to consumers. So these are consumer installment loans where you have borrowers that are buying a good. In this case, it would be motorcycles, power sports vehicles, ATVs, UTVs, scooters, jet skis, and they're financing that. And ultimately, we're investing into a diversified pool of these instruments. That's consumer exposure. If I think about just macro where the consumer is today, there seem to be a lot of headwinds, right? You have post-COVID supply chain disruption, which caused massive inflationary pressures. And then you had subsequent responses from banks around the world increasing interest rates. The US economy is made up roughly 70% consumer spending. And so generally what you hear in the market and what you hear in research and the press is the consumer is stressed. Savings are depleted. What's going to happen? In reality, what we see is that unemployment is still pretty low. Consumers are still spending. There are some sort of cracks around the edges, but generally speaking, where we are in the cycle right now, things have held up pretty well. And so we're really excited about this opportunity because it exploits some of the inconsistencies that you see in the press using structural advantages, collateral protection, predictable cash flows, and we've created an investment here that we think makes a lot of sense.
You and I have also spent a lot of time talking about different vintages, when some of these pools were kind of invested in and structured and built. Maybe you could speak to a little bit about how that plays into the thinking.
Sure. So probably the most important way to think about this is with all the stuff that I mentioned before about increased rates, fear in the economy, that's led to a general pullback in credit. So what has happened across lending is that everyone's tighter and they're paying more attention to who they're lending to, what they're lending against. Better credit conditions. Combine that with the fact that you had a massive repricing. And so at a very baseline level, what you're buying today has the highest rates that we've seen in a very, very long time. The last 6 and the next 12, 18 months from a vintage perspective should be some of the highest returning risk-adjusted yields that we'll see in fixed income private credit markets.
So maybe to start at a really high level, you can walk everyone through the individual portfolio here.
Sure. So at a baseline, just to really explain how it works, a consumer walks into a dealership. They want to buy an $11,000 motorcycle. They have $2,000 in cash and they want to finance the rest. They pick out the motorcycle they like. They go to the dealer, not to pay to the desk, but they talk to the sales representative and they ask, what are my financing options? The dealer goes to the computer, comes back, and the software that Octane provides an automated underwriting that takes into account that consumer's specific situation and provides a rate and a loan term. That's the basics of it.
So you mentioned that Octane really has a software and a platform that really helps with some of the credit underwriting. Maybe you could speak a little bit more to that.
Sure. So they've partnered up with over 40 OEMs, that's equipment manufacturers. So likes of Kawasaki, Suzuki, Polaris, all big manufacturers. They're in over 3,000 dealerships. So pretty widespread of how they can originate loans. Then on the back end, the underwriting system takes into account credit bureau data to understand how consumers need to be priced. There's some pretty complicated modeling, algorithmic approach to underwriting, and it comes back with a risk-adjusted pricing. The two extremes of that would be somebody with a very low FICO score that's going to have a higher rate on that loan, and somebody with a very high FICO score that's going to end up having a lower rate. And so that's essentially behind the scene what happens. What we've done over here is we've gone and bought a large pool of these loans. There's predictable cash flows. We can model out stress scenarios, and we can structure away some of the risks that we think exist broadly in credit markets.
So before we kind of jump into some of the structural enhancements that you all have kind of crafted, let's take a step back and talk a little bit about Octane. Who are they? Why were they someone that we were really interested in partnering with?
Sure. So, they were founded in 2016. Today, they're a top 5 lender. They're, I believe, the only independent lender that's in that group. They are a frequent issuer in public markets, so they're well known by institutions. They have done 9 rated bond transactions. That's about $3 billion in deals. They have access to financing close to $1 billion from very large, well-known banks that we all know. So very strong institutional support, very strong product. They have had very strong performance history for the bond deals that they've issued. And we had a very unique opportunity here to go in and create a private transaction, the first of its kind. Super excited by this. Company has 600 employees and they continue to grow.
So he's talked a lot about as well, the collateral. Of course, first, what does that really mean? And then 2, what does it look like in this transaction?
Sure. At a really high level, we have a little bit over 12,000 individual loans that all have specific contracts that tell you how much the individual monthly payment is. There's information on the borrowers behind that. There are fixed coupons, and we have a lot of information behind this collateral pool. Generally speaking, I'm going to give you some rough numbers here. We're talking about an average loan balance of around $11,000 per line item. We're talking about a pool that is majority prime consumers, and then some near-prime consumers as well, but it's mostly prime. And coupons on the underlying collateral that's in the high teens. That's generally what it looks like. I think there's more nuances, but that's probably the best high-level overview to think about.
And then, you all spend a lot of time thinking about how to structure this to, really help as you identified some of the risks or some of the concerns, how to structure the transaction in a way that made you all comfortable with the return that you're getting for the risk that you all perceive. Maybe walk me through that structure.
Sure. So one thing that I want to re-emphasize is that this is secured consumer installment loans. There are hard assets behind. So if, for example, somebody falls behind on a payment, you have a motorcycle or a UTV or an ATV that you can go and collect on and then sell in the auction market. The way that we model this transaction, which is in line with what they've done historically, is roughly a 30% recovery value if things go bad on an individual loan. So that's one very important piece of the puzzle, is that you should always get some money back on individual loans, even if they don't do as expected. Again, it's a very diversified portfolio, 12,500 individual line items, very predictable stream of cash flows. So you can model out what you expect this pool to throw off from a cash perspective. We assume that a certain portion of the pool does not perform as expected, and we take that and we stress it to see, is the amount of money coming off this collateral pool enough to support the return that we believe we can be offering? And generally, with this type of collateral, because of the fact that it's very high yielding, because it's secured, and it's predictable, and it's diversified, we look at the historical deals that they've done, and we basically stress the historical deals roughly 1.5 times to come up with our base case analysis on what losses should look like. That's generally how you think about the economic analysis. Our yield on this portfolio, we believe, can withstand a 1.35 times historical loss stress before yield ever gets affected. We believe it can withstand almost a 2 times multiple on historical losses before your principal gets affected.
And these historical losses are what Octane has witnessed in their history, or is this a broader?
That's exactly right. So this is taking a look at what Octane and the 3 billion of transactions that they've already done since 2016, how those pools have performed over time. So we're stressing it, come up with a more conservative base case, and then we're stressing that base case to see when do things not work.
And also when you think about some of the structure and some of how we expect the underlying loans to perform, certainly a lot of these consumers pay back a little bit early. What does that mean for the real world duration of the portfolio?
Sure. It's important to think about cash flows in terms of the contractual nature of the underlying contracts. These are amortizing loans. The underlying loan is usually 6 to 7 years, but the borrowers are making principal payments every single month. Those payments, along with the interest payments, are being passed through to investors. So amortizing cash flows means that even though the contract length is longer, the amount of time that it takes to receive your initial investment back is much shorter. That is roughly around the 2.5-year point. And so this is an investment that is paying you current cash flow. It's paying you a portion of your principal back. It looks very short from an investment duration perspective. Now, I think there are 1 or 2 important nuances to point out. In order to collect this diversified pool, we've also utilized financing from a large global investment bank. And structurally, there are elements where if there is stress in the macroeconomy, that could lead to some of the loan being accelerated and the cash flows being slightly delayed.
So you spent a lot of time talking about what you all have really liked about this opportunity. What maybe were some of the risks that you all identified and really tried to think through?
Sure. The first and most important is probably what's foremost in most people's mind is the health of the consumer. We modeled out what happens in stress scenarios. If there are large defaults in the portfolio, that will affect return. We think we're protected here. Second would be lower recovery values on equipment, motorcycles, UTVs, ATVs, if they have to get foreclosed on. We're already assuming a very low recovery value, but that could be something else that changes the return profile. The third would be any disruption from the collection system, the servicing of the loans. The company itself has a large number of employees that are dedicated to these collection efforts, so we feel good about that, but we also have some backup options in place should things not work. Lastly, this is a transaction where there is some senior leverage in place, and we put that in place primarily to build a diversified pool, but there are certain elements to the transaction that could change the cash flow profile of our investment if there's macroeconomic change in the portfolio.
So Fahd, with that, thank you so much for joining us today. To everyone else, thank you as well. We really look forward to further conversations and hope you check out the new opportunity at yieldtree.com.